Good afternoon, everybody. Thank you very much for being here. We've got a fantastic panel here for you and a somewhat limited amount of time, so we're going to have to be somewhat economical with our use of that time. What we wanted to do is talk a little bit about financing inclusive growth, and within that, we'd been narrowing that down a little bit and focusing on businesses that. And I think it's fair to say for all of the panelists here, this is all around emerging markets, and it's focused around businesses that are not the let's say the unicorns or whatever the equivalent of a unicorn in Uganda might be, and also not the livelihood supporting businesses, the kind of entrepreneurs by default, but what I've labeled the bread and butter businesses. So where we're thinking these are businesses that have a growth ambition and a growth capacity, and as such have a very significant role as an engine of job creation. And how do we get money to those businesses, and how do we achieve scale in that? But before we go further, let me allow the panelists to introduce themselves very quickly. So that you have a bit of a sense who you've got in front of you. As was said, I'm with Include. We are a capital advisory business, if you will, an investment bank for impact, and we're part of the Palladium group. We do a lot of work in transactions, helping funds and businesses raise money. We help people sell assets in a way that allows for mission to be continued, and we do a whole suite of financial advisory services around those kind of capital markets questions, if you will. Andrew, can I ask you to introduce yourself?
Hi, everyone, and again, thanks very much for being here and for inviting me. Great pleasure to be here. My name's Andrew TILLERY. I'm Palladium's Director for Asset Management, also the Chief Executive of Palladium's Impact Fund. That's a fund which for the past 3 years has been investing into small growing businesses in Africa from the Palladium balance sheet. We have not leveraged any third-party capital as yet. We target the agribusiness value chains and also off-grid clean energy, primarily within 3 countries where Palladium already has a significant presence, those being Kenya, Nigeria, and Ghana, where Palladium has several projects in each of those countries and several hundred employees in each of those countries. So we're a small team, a small investment team, should I say. Although that said, together with our investment committee members, we have a combined experience of over 50 years of investing in the private equity sphere, of which roughly half of that is in impact investments. And we're now looking to leverage the Palladium presence in the countries that I mentioned in order to achieve impact in the way that we would like to see it in small and growing businesses. I guess that's about it from me. Thank you.
Good afternoon, everyone. I'm Esther Pan-Sloan. I'm with UNCDF, the United Nations Capital Development Fund. We're a UN agency focused on economic development in the poorest 47 countries in the world, which are known as the least developed countries. We were traditionally grants in, grants out, and we would make grants in the areas of financial inclusion to bring individuals into the market by giving them access to savings or credit, and local economic development, which was focused on building the capacity of governments at the subnational level to collect taxes, build infrastructure, and deliver services to their people. In 2017, we started what we call the LDC investment platform, which is making loans and guarantees to small and medium enterprises in least developed countries to fill what we call the missing middle gap, what Stephen's calling bread and butter businesses. And our target ticket size is between $100,000 and $1 million, most of them around $200,000. And we always work to bring in a local bank into the deal so that local financing is involved. And happy to talk more about that later. Thank you.
Afternoon, everybody. My name's John Fairhurst. I work for the Global Fund, and Raj gave us a name check actually earlier on. But the Global Fund was started 15 years ago. We are a public-private partnership whose goal is to eliminate HIV, TB, and malaria and build effective health systems around the world. We work very closely with the private sector, obviously, particularly the pharma sector. And I don't know if Alonso's still here, but I don't think the health sector has solved the problem yet of engagement with the private sector, but we may have made some positive steps. But we work in over 100 countries. We spend about $4 billion a year using grant funding as our principal mode of operation. But one of the things we've recognized is the need to work with the private sector and build new and different financial instruments. If we're going to really eliminate diseases, we need better and deeper engagement, and that also involves sort of new instruments, new types of engagement with the private sector to get there, and not just the health sector as well.
Drew Von GLAHN. I tend to wear a number of different hats, but here I'll speak on behalf of the Collaborative for Frontier Finance, which is about a year-old organization, which is a multi-stakeholder initiative that is seeking to address what are the gaps and can we try to solve for the gaps in small business financing for growth-oriented companies. And so this is a collaborative of multilaterals, a major foundation, so it's the World Bank, it's the Dutch government, the Australian government, as well as MacArthur Foundation, Midyar Networks, and then small foundation in Argidius out of Europe, all trying to bring together multiple stakeholders across the spectrum to see if we can't focus on the challenges at the financial intermediary level. So we're not focused on explicitly looking at the enterprises themselves, but on the vehicles that are putting money into them, either at the equity capital or the debt capital structure, and we'll talk more about the different components of that as we go through it. And it's across the globe and in the emerging markets, as Stephen had referenced.
Great, Drew. I might stay with you if that's okay. As I started to overview what we're trying to do, I talked a little bit about segmentation, and I think if we've learned anything in our world, it's that segmentation and figuring out the right way to approach the right parts of the market is crucial. I know that you, as the collaborative, have done a bit of work in terms of sussing that out, and I was wondering if you could give me a little bit more background as to where you've arrived at, and also what kind of conclusions that's beginning to lead to, if you will.
Fine, let me try to answer that quickly. A quick step back. The collaborative is going to take a three-part focus. One is looking at research, but research to an end, i.e. just not one more paper that sits on a shelf. And this is in part what Stephen's referring to. I'll pick back up. But the second is what we call transparency. There's a lot of knowledge out there that's just not being shared. So we have a tremendous amount of information asymmetry just for lack of sharing information. And third is actually testing and piloting initiatives. And that's where the research and the transparency hopefully lead to. So in terms of the segmentation, we've been working on a couple of different reports. One now about a year-ish old, which is looking at the fact that small businesses are not all the same. And we've been, unfortunately, in these markets trying to apply one tool, one methodology, i.e. the Silicon Valley 2-in-20 equity structure for most equity deals, and then trying to squeeze traditional debt financings into this. And what we've been able to really suss out is by looking at these segments, and the one we'll focus most on today is what we've referred to as the dynamic enterprises or growth-oriented enterprises. So these are not the ones that Silicon Valley type investors are going to be looking at, but those that could grow from a few staff to maybe 1,000 or so. And there's some really good research done by Endeavor Insight as to once a firm gets near that 1,000, how it really does drive sustainability and long-term domestic economic impact. So again, trying to core focus on it. So what we're now trying to say is, okay, within that, and we'll talk more about instruments and other things in a minute, is if that's a segment and we're looking at people that are trying to raise as a reference point anywhere from 500,000 to 2 million in the next stage of capital raising, is what are the business needs explicitly of that group that is growth-oriented, dynamic, versus, say, a livelihood company versus a a super high unicorn oriented? And can we be more explicit about the capital structures and the approaches to doing that? So the first thing, as we said, we were breaking down is who are we talking about and what are their needs, so we can then be much more relevant about the capital structures that are applicable to them.
Great, thank you. Andrew, if you guys have been looking at a lot of businesses, specifically in ag and energy, when we talk about these archetypes, does that have relevance? Do you recognize these three types in terms of businesses that you guys see, and are there certain segments more likely to be good borrowers than others for your platform?
Very much so, and it's the dynamic enterprises which are of particular interest to us. If I can just quote something that Joseph said earlier on, success is 10% about strategy and 90% about putting things into practice. So the very first thing that we do look for is a good business thesis. We like to look for a thesis that we believe fundamentally will work, that has an advantage over other people that might be playing in the same market, trying to do the same thing but in a different ways. But then the 90%, and probably the most important thing that we look at, is the management of the business. Do the management have the capabilities to be able to roll out their strategy? Is the management team complete? And invariably that means that the management team has to have some sort of financial acumen. It's very common to come across an entrepreneur that has a fantastic idea, but doesn't have an awful lot of, shall we say, expertise when it comes to deriving the best capital structure for his business. So we do try and get in early in order to help the entrepreneurs to do that, because capital structure is everything. If you get the wrong capital structure from the start, then that's either going to result in something undesirable, a negative equity position. It's going to result in a business which is significantly overgeared. It's going to result in a business that can't possibly take on any more debt. And we are a debt fund, although when I say debt, what I mean is self-liquidating instruments. So that does extend to mezzanine type structures as well. Ultimately, what we're looking for is an instrument which suits the business, because we do not want our investment to hinder the growth of the business by introducing unrealistic covenants in debt documentation, or introducing a debt burden that the company can't afford to service. So businesses in that sort of dynamic growth sector are ideally placed to take advantage of the type of investment that we're looking to provide, in that we're looking to take them to that next stage of growth, ideally incrementally, because a business that tries to grow too quickly will make big mistakes. A business that is looking to grow incrementally will make mistakes on a smaller scale. Everybody will make mistakes. That's a fact of life. We just want to make sure that those mistakes are manageable. They don't cost too much money. They are learning experiences, and those businesses can progress to the next stage of their growth without having caused too much damage to that growth trajectory. I just would add one other thing, that in order to take that approach, it does require, this is not something that we can impose upon a business, particularly as a debt mezz type investor. It's something that the entrepreneur has to understand. So the very, very ambitious growth targets that you see in the first category of investment, Stephen, that you mentioned, the venture type growth deals, where projected growth is exceedingly high and more attractive to VC type Silicon Valley investors. In Africa, certainly in the value chain or in the segments that we're looking at, just doesn't work. So we're looking for people that have got realistic expectations about the rate at which they're going to grow their businesses, and we look to partner with them to take them across what we call the bridge from the stage at which they're at, which invariably means a stage up until which they've been reliant upon grant finance, through and across the bridge, across it preferably, to the point where they can raise commercial and institutional capital. So in other words, much larger tickets. We typically do $250,000 to $2 million of debt or mezz. So let's say an average of $1 million. We're looking to position businesses in such a way that after our investment has self-liquidated or is well on the way to doing so, that these people can really scale up, approach the DFIs, approach the bigger institutional investors, and raise the big money that is going to take them to that next stage of growth. That might take time. We expect it to take time. Those are the kind of things that we're looking for. Thanks.
Thank you. John, I'm just wondering, in the health space, these archetypes are probably slightly less useful. It's probably less about small entrepreneurial businesses.
I mean, I think like all spaces, there are different types of actors. I mean, I think the thing, and this is maybe part of the response to Alonso, is in health is that there's a big piece of the health space which is about health, which is about pharmaceuticals and diagnostics and many other things. And I think obviously in that space, small is difficult. There's a huge amount about the health space which is nothing to do with health. It's about technology and supply chain and infrastructure and many other things, solar power for health facilities. And I think in those spaces, these archetypes are actually potentially really interesting because many of the opportunities to support and increase the efficiency of the health system, the delivery of care, is about building better solutions. Much of health delivery involves the private sector in supply chains, in drone delivery, as a developing area in technology providing the applications for telemedicine. So in that space, I think these archetypes are really important to understand how you create thriving businesses that are creating relevant solutions. I do think, one of the challenges we have, though, is that when, as an impact-focused organization, we're clearly about driving engagement from the private sector to create impact. Now, obviously, you can create impact by having greater cost efficiency and having innovations that create more impact per dollar. And so that's a really powerful way to support businesses, both big and small. Maybe this is a question that we'll come on to, but I think as we think about the financial instruments that incentivize impact within the health sector, across many of the countries, health is provided by the private sector. If you go somewhere like India, 50 to 60% of healthcare is provided by private sector operators, by private pharmacies and private clinics. If you look at TB as obviously a key disease, the Global Fund is interested in 80% of the first contact for TB. So 80% of people who get tested for TB do it in the private sector first. And one of the challenges we have is about incentivizing and mobilizing the private sector with a business imperative to get them to track TB patients, not just to sell them the medicine, but actually establish the relationship and the patient care relationship with those patients that allow us to maintain the support to eliminate the TB from that patient. And so I think these archetypes that look at the range of people who are providing private healthcare or private sector care in health are helpful in thinking about the right way to invest in those businesses to create performance and impact, as well as create business models that are successful.
Great. Let's shift gears a little bit and start thinking a little bit about the instruments that we use, both at the end borrower level, if you will, and potentially at funding for these initiatives. it seems to me that pretty much every fund that we get involved with now is a mezzanine fund. And I think there are a lot of good reasons why that would be the case. But I do sometimes wonder whether it's just the latest fad, or whether there's really something there. And I think not least of which is of the issues is it's at the end of the day, the fact that you've got an instrument that has elements of debt and elements of equity in a place where both have challenges makes sense. But the flip side of that is it's not always very easy to understand really what you're trying to achieve with those mezz instruments. Are you really just following a fad, or are you taking an equity risk but hiding behind a debt facade? And if so, are you getting the right return for the risk that you're really taking? And I think there's some real challenges there. But let me, Drew, maybe ask you first. Would you reckon fad or useful tool?
I am known for, on a personal crusade, to try to kill the reference mezzanine debt in these emerging markets, because, as Andrew said, they're really about self-liquidating capital structures. I'd like to refer to more structured financings in the sense that mezz has in the US and in Europe, has a very legal structure, where in most of the markets we're talking about, the ability to stack your collateral is still a very challenging thing, versus just thinking much more strategically about your financing structure, as Andrew was saying, to the investment that you're trying to support. So another piece of research that we've just focused on and will release shortly, that was supported by Shell Foundation and done in unison with the University of Cape Town, was around different types of archetypes, looking at how fund managers are explicitly trying to finance. And in the context of what we're talking about, we really came up with 3 groupings of, again, what I would call structured debt type funds. One was what we call value chain, which was those that worked in a local economy that were either directly part of a supply chain, i.e. a mining company type thing in South Africa, say, but also it may have just been relevant to the local ecosystem, where knowledge of that local ecosystem was highly relevant in your ability to finance them. Most of these firms needed, for their purposes, working capital type structures. But again, they were at a stage of their growth, as Andrew was implying, that there were still a lot of challenges in front of them. So that was the first group that we came across. The second one was what we call small ticket asset based, which in many other markets looks a lot like lease or securitization type opportunities. But again, where they're needing machinery, they're not looking to build a massive thing, but they need something for growth. So again, you're being very explicit about aligning what they need their monies for to the capital vehicles and the instruments that the vehicle could use. And the third is what we refer to as venture debt, which is really where you're funding the growth opportunities that are much more intangible, i.e. the sales and marketing team, the research and development, the back office things, the things that are hard to collateralize or be explicit about its outcome in terms of profitability and cash flow. But we all know, as anybody that's made any investments, and again, Andrew can speak well to this, if you don't make those investments, you're not going to go very far. Long term. So being very explicit within the structures as to what they are. So I don't think it is a fad, but it's being much more explicit about within the structured financing, i.e. mezzanine financing, what problem are we trying to solve at the small business growth stage? Where are they? What are their needs? And then aligning that capital structure explicitly with them, both from the fund, but also the fund manager or the capital provider, their own capital, how they're getting it and who's providing it to that. If it's a bunch of people that are looking for rapid returns and they're doing venture type structures, those will not align. If they're looking for returns that are safe and predictable, the working capital value chain becomes much more interesting and applicable. So we're seeing that type of alignment is what we need people to start focus on. So it'll move from fad to reality if we can get much more explicit.
Good, thank you. Esther, you see a lot of different funds, including presumably ones that use mezz. Do you have? Do you like it as a organization? Do you see other structures or instruments that you prefer? Do you feel there's scalability in the instrument?
Those are good questions. So we're actually launching a fund this year. We started doing loans and guarantees in 2017. We now have 16 of them in 5 countries. And this year we're launching a fund with Bamboo Capital Partners, which is a Switzerland-based impact investor, to take that portfolio of loans and guarantees that we will make loans to up to $1 million. They'll take them $1 million to $5 million. So to provide more of this growth capital. And if we use Drew's categorizations, all of our loans are for working capital. It's to buy equipment, it's to lease a factory, it's to do agri-processing to increase the value of the commodity to the farmer. So we're not doing kind of some of the more fancy things that might be in the options. So I think from our purposes, the structure of that fund with Bamboo will be a mezzanine structure. There will be a first loss piece that we're looking to raise from member states as donations. So the goal is to raise $10 million in first loss, of which we have $2 million already from Luxembourg, and then $10 million to sit as a mezzanine piece on top of it. That would be return-seeking capital. And our working assumption is that we needed this structure in order to attract financing to this type of deal. Very small, very risky, least developed countries. We find that investors, including local banks and insurance companies and pension funds in least developed countries, are not eager to invest in entrepreneurs in their own countries. And the entrepreneurs that we support, because they have to have a development impact from their business, it has to have a food security or women's economic empowerment or some other development impact aligned to the SDGs, they're not, your number one choice for a bank. Usually our entrepreneurs don't have much of a track record. They certainly don't have 3 years of audited financials. They may not have a very good business plan. So they're really at a stage where they need a lot of technical assistance and hand-holding, usually some grant capital as well, before they even qualify to get a loan. So for our purposes, for the types of businesses that we're doing at the ticket size with the risk characteristics, also in local currency, which we don't hedge because it's usually too expensive, we find that we really need the mezzanine structure. The goal is that if we do this, eventually the businesses will grow and then they can go on to find commercial capital without any concessional capital involved. But the risk that we were talking about just before the panel started is that your investors get very comfortable with the mezzanine structure and they don't then do it themselves on a commercial basis.
Okay, thank you. Andrew, when we spoke before the panel, you made an interesting comment, and I think you alluded to that earlier as well, where you say entrepreneurs can back themselves into untenable balance sheet structures, and you had, I think you had a particular concern about some of the convert instruments that you're seeing out there. Do you want to say a few words about that?
Sure. The one particularly unpleasant instrument that we don't like to see in any of our potential investees is the convertible loan note, which will sit on a company's balance sheet as a liability, continue to accrue interest that cannot be paid by an early stage business, but has written into it the optionality to convert at a deep discount to Series A equity whenever it is that comes in. Now, if I were a Series A equity investor, then I would be a little bit off-put by that. I would be off-put by the fact that my investment, which would be based on what I consider to be a fair pricing as negotiated with the entrepreneur, was going to facilitate the conversion of notes which had been accruing interest at a deep discount to my own investment. And I think in very general terms that makes it more difficult for enterprises that have these notes in their capital structure to actually raise that Series A equity. If they can't raise a Series A equity, they are stuck in almost a vicious cycle whereby they have a negative equity position and therefore they cannot take on any more debt. Or they can't take on any more debt besides the loan notes that they already have. If they can't take on that debt, what that does is it sort of pushes them back to most probably where they started, in that they become not so much reliant, but very, very focused upon raising more grant financing. And that's a step back, because grant financing, as we all know, is not sustainable. It will give you a springboard from which you can take off, but you don't know where you're going to land, and the pool might be empty.
Yeah, I think that makes sense. I think from our point of view, I think these converts they work if you've got a high degree of confidence in a next round, and you've already got visibility on pricing. If either of those are missing, it can be a bit of a death trap. Keeping an eye on the clock, we also want to leave some time for questions. We were going to talk a little bit about returns. Let me maybe select out one question. John, when you and I spoke, you made a very interesting point about feeling that the world is kind of too bifurcated between impact first and return first, and how that is inhibiting some of the more useful models potentially. Do you want to tell us a little bit more about that?
Yeah, I mean, I think, I mean, the last panel talked to this. I think Raj said it. I do think we're at a point of sort of transformation in the sector in terms of the perspectives around financing. I mean, everything we've heard from people today. I think, you know, there's an inevitable focus on the existing mechanisms, on mezzanine, on equity investments, on grant funding, and of course they're very powerful, and they're very important spaces. But I think the transformation will come from the things in between those, the blending of opportunity. And I think the critical thing, and you know, we've certainly seen this at the Global Fund, is that it's not the blending of the money. It's the blending of the agendas that drive the financial structure. And I think we're still struggling with the ability to blend organizations like ours that focus on impact and organizations like many in this room who focus on return. And until we can cross that divide, what I said to Steve when we're talking about it, it feels a little bit like we're standing on opposite sides of a very fast-moving river, and we're each jumping into the river, but not at the same time. And we're standing there waiting to see who will jump first. So I think there is a huge opportunity here to really create inclusive growth by, you know, this agenda of financial return with impact, or impact with financial return, by looking at new instruments that have all the elements of the things that we've talked about, but also are not the same. And so one example of that you know, we've been working on is an impact fund. And it starts on the basis that as the Global Fund, we have an incredible intellectual knowledge of the health system, of what works in the health system, what's missing in the health system, what would be impactful in the health system. And that isn't articulated. We don't articulate that clearly in terms of opportunity for business to engage. And I'm not talking about pharmaceuticals and diagnostics, but I'm talking about telemedicine and supply chain technologies as well. And if we articulate that clearly to an investment fund, and if we partner with an investment fund to build an impact fund which is framed around the impacts that we care about, but is also supported by our intellectual knowledge of what pipeline would be supportive of our agenda, we create a new mechanism which is both supported in terms of building pipeline, but supported in knowing that there are market opportunities. So there are no promises here that we will finance anything that's developed. We can't do that as a public organisation. We can't make guarantees. But we're not exploiting the intellectual capability we have of understanding health systems deeply to allow companies to develop the right solutions, and to incentivize companies to develop impactful solutions that have business models underneath them. And I think it's this blending of approaches and the financial model which is designed with the blended approach in mind, that will really unlock a huge scale of inclusive growth and impact and return at the same time.
Great, thank you. So we've got 4 minutes. Are there any questions from the audience? Yes, madam. Are there microphones roving?
Yeah, thanks very much. This is a really, really interesting and strategic panel, so I appreciate everybody's contributions. My name is Donna Katzen, and I work with Shared Interest, which is partnering with Palladium in Malawi. And we provide loan guarantees and technical support to small and growing businesses, smallholder farmers, and co-ops. So my question is to Esther to say something more about guarantees, their role as catalyst, as lever, and perhaps exit strategies to mobilize local capital, particularly in pursuit of the SDGs.
Great. Well, thank you very much. So the head of our LDC investment platform, Anders Berlin, was the head of Swedish SIDA's Loans and Guarantees office. And he actually came to UNCDF on secondment because Sweden was interested in building this capacity at the UN. So because CDF had supported many private sector companies in financial inclusion and financial services over the years with grants, we noticed that some of them happened to do very well, like Equity Bank in Kenya. So the loans and guarantees were a natural step. We had the mandate for it since our founding in 1966, but we didn't have the technical capacity to do it. So Anders came and built that team. We haven't made any guarantees yet. We've approved 2, but there are so many regulations you have to go through at the United Nations, which is not a surprise. But one of them concerns guarantees, and especially guarantees to local banks. So the way we intend to use it is to guarantee a local bank to make a loan to either a certain company or a certain type of company, women-led business in this ticket size, doing food security, something like that. The risk there, again, is that if once you make the guarantee to the bank and the bank takes advantage of your guarantee and makes the loan, if you are not offering the guarantee for the next round, will they make a similar loan when they see a similar entrepreneur? So that's how we're intending to use it. We haven't done it yet, but I hope that we will soon, and then we can report back on how effective it is.
Great, thank you. One more very quick question. Okay, oh, sure.
So I think John was getting a little bit at the idea of how does one come up with innovative ideas for financing or unlocking financing for system solutions, right? I think most of the conversation has been about funding individual companies and SMEs. I'd be interested in just getting a little more thought taking from this morning's conversation where we're looking for, let's say, some innovative business type solutions that are then need to be able to get finance into the system when and where it's needed, right? Which is probably different kinds of finance for different kinds of players. Have any of you experimented with that kind of situation?
We've thought about it. I mean, so that's the end goal of this experiment. So UNCDF is a small agency. Our role is to innovate, test out solutions, and then hand them off to bigger players when they succeed. So we've done that in financial inclusion and economic development. The idea with these tools that we're building, we also launched an ETF last year. That was the first UN ETF. We're going to do this debt fund. We're going to do a municipal investment fund that will buy the bonds of developing countries, cities. The idea is that we're now kind of at the forefront of the UN in testing out these instruments. And if we can make them succeed, then we can build a platform that's UN-wide, or even better, UN playing a role in the international financial architecture wide that focuses on, in our instance, least developed countries, the bottom part of the value chain, getting companies up to a point where a World Bank or a DFI would invest in them. And then we could play kind of a system-wide role in coordinating UN efforts to fill that particular bottom part of that missing middle financing gap. And also in consolidating, coordinating UN efforts on innovative finance, of which there are now very many, but they're very spread out and uncoordinated, and they don't link clearly to a scaling partner like the World Bank or a DFI. So that's the goal, but it's still several years in the future.
So maybe just a quick answer. I mean, it's very much in our agenda is to look at new financial models that create a space for capital to flow. When you're working on disease eradication, it's a big, obviously it leads you to a big question, almost by definition. So one of the spaces we've been looking at is this idea around outcome financing, and the idea that you create a space that attracts risk capital to finance a series of solutions. But very different to typical grant funding, you create the space for that risk capital to be deployed flexibly because the outcomes define how you get paid. And what that does is create a very different orientation for solving things like malaria, where you're actually creating investment spaces for technology, because malaria elimination is a lot about very forensic analysis of where malaria is. It's about really detailed data systems and rapid reaction. It's about provision of commodities, which are provided by the private sector very rapidly. And so the mechanism like that creates an environment where you're creating a performance space for investment in the right solutions and the right businesses, and often local businesses too. And when I talk about businesses, I'm also talking about not-for-profits. I'm talking about NGOs as well as for-profit businesses. But you create a different space that brings a different set of actors into the agenda. So I think that, and also the impact fund I talked about earlier on, are areas where we think you can create a systemic model which is creating spaces for investment that wouldn't have been there in the first place.
I think I'm going to have to round up before I get into major problems here. So thank you for that. Thank you very much to the panelists. Really appreciate your contributions. Super interesting. Thank you for doing that.